A factor is a property of a security that helps to explain risk and return. Factor exchange. Traded funds, ETFs, may help investors raise their return, improve investment performance, and minimize risk. Factor exchange. Traded funds, ETFs, are not pure trackers. They diverge to some degree from just rising and falling with the selected market. We'll talk about factor investing ETF in this video. Stay tuned and watch till end so that you don't miss any important part. Don't forget to subscribe to our channel. Let's get started. What are factor exchange traded funds? Trackers and exchange traded funds, ETFs, that follow a basic, passive approach of tracking a predetermined market or index have acquired enormous popularity over the last few years. This is due to the fact that it is now common knowledge that conventional stock selecting does not always succeed. There are several downsides associated with using a pure tracker, which entails purchasing a market, such as the S&P Wink with ton sticking out 500 or the FTSE in the United Kingdom. Investors are entirely vulnerable to all of the market's shifts, despite the fact that the market is very transparent. As a result, it should not come as a surprise that hybrid models have arisen. These models are still tracker ETFs, but they are purposefully skewed in one or more aspects. These investments are often referred to as factor ETFs. The qualities of a security known as factors are ones that may assist in the explanation of risk and return. To help investors maximize returns, improve investment performance, and reduce risk, factor exchange traded funds, ETFs, are a useful tool. Factor exchange traded funds, often known as factor ETFs, are not identical to trackers in the sense that they depart from the underlying market in some way beyond just rising and falling in tandem with it. Because these ETFs are still quite new, it is difficult to determine how beneficial they will be. Despite this, the line of reasoning is strong enough to suggest that a careful investment may result in a profit. Here's a guide to factor ETFs. By shifting away from plain vanilla trackers, one can increase the rate of return and/or level of risk without engaging in costly and time-consuming stock selection. This change is known as bias or tilt. In other words, these products are not pure trackers. They do not simply rise and fall in tandem with the specified market. The following factor ETFs illustrate the operation of these vehicles. iShares MSCI USA Size Factor ETF, size. iShares MSCI USA Momentum Factor ETF, MTUM. iShares MSCI USA Value Factor ETF, VLUE. Each iShares ETF has a distinct bias, with one favoring small companies, another favoring companies whose stock value is accelerating or gaining momentum, and a third favoring stocks that may be undervalued by the market. The size factor ETF from iShares focuses on U.S. large and mid-capitalization stocks with substantially lower market capitalization, based on the premise that smaller companies are often disregarded. The Momentum Factor ETF invests in companies with accelerating price and volume, while the Value Factor ETF weights shares based on 4 accounting criteria and compares them to the underlying index. These 3 strategies bend the fund away from exposure to the index of your choosing. All of these kinds of bias make financial sense, and if correctly calibrated, should result in a quasi-tracker that outperforms a pure market buying vehicle. Hope you find this video useful. Make sure to subscribe to our YouTube channel before moving further. Now we'll take a look at how effective are factor ETFs generally. These ETFs are very new, therefore their track record is limited. Nevertheless, the reasoning is sound enough that a prudent investment could be profitable. Ensure that you fully comprehend how the items function. The more an ETF deviates from the pure index benchmark risk, the more sophisticated and active investors may find it suitable. There are several ways to apply these notions in the real world. Since the firm's inception in San Francisco 7 years ago by Jonathan Tunney, CFA, Atlas Capital has offered a variant of the concept known as enhanced indexing, utilizing value, size, and momentum, as well as a short-term reversal in separately managed accounts for large dollar amounts. This latter word relates to return over the preceding month, which often exhibits negative serial correlation, while medium-term momentum has positive serial correlation. The Atlas portfolios use the aforementioned four characteristics as improved indexing components, which they integrate into a single approach. In other words, Atlas does not use the ETFs mentioned above in their purest form, but has customized the idea for use in its own stock portfolio. Tunney, the creator of Atlas, asserts that the firm's factor model methodology allows it to provide customers portfolios that are liquid, transparent, low cost, and supported by years of academic study. He argues that factor ETFs cut the price of typical actively managed funds by offering a low-cost product that is nonetheless well-researched and may produce returns that exceed the market. The providers of these products often propose them to investors who desire exposure to other risk variables and alternative beta. However, until they achieve acceptability, factor ETFs will have liquidity concerns. Other illustrations of factor ETFs. There are a plethora of additional factor ETFs on the market, since they include all common market-wide drivers of securities return. Fidelity, for instance, provides 15 factor ETFs spanning regions and asset classes, including domestic equity ETFs and international equity ETFs. The objective of the factor ETFs offered by Fidelity is to give exposure to the specified factor while reducing risk. The most recent Fidelity U.S. multi-factor ETF, FLRG, is designed to invest in U.S. firms with significant exposure to value, quality, low volatility, and momentum factors and little exposure to size. FlexShares, Northern Trust's ETF division, also offers funds based on a multi-factor model strategy designed to place a greater focus on foreign small caps and value equities. FlexShares Morningstar developed Markets X, U.S. Factor Tilt Index Fund, TLTD, and FlexShares Morningstar Emerging Markets Factor Tilt Index Fund, TLT. ETFs and trackers are here to stay, since it is generally understood that paying someone to just beat an index is a waste of money is often detrimental. However, pure trackers have drawbacks since they provide no protection against market fluctuations. New factor ETFs provide a compromise by tilting away from an index. If you are a more seasoned or daring investor, factor ETFs may make sense as a source of diversity and a possible way to enhance your portfolio. Profit up to $10,000 while investing in digital assets. Digital asset trading just becomes simpler. With OKX, a major supplier of digital asset finance services, you may trade and store assets with world-class security. In addition, you may win a mystery box worth up to $10,000 if you deposit at least $50 via a crypto purchase or top-up within 30 days of registering. Learn more and join up now to get your mystery box. That is it for today. If you enjoyed watching this video and want to hear more from us, let us know in the comments and subscribe to our channel for more videos.